There are three things that you need to know right now today. The first thing is the US consumer. The second is the Federal Reserve. And the third is the big money. Where is it? Where's it going? All of that and more. Let's go. I'm going to navigate you through what is happening today inside of the markets. I'm going to show you what that means to you, your wallet, your portfolio, and of course, the economy in general as it will affect you. Stay with me through this. I'll break it down nice and easy. This article happens to be out of Market Watch. We're looking here at what had happened in this particular trading session, but let's be honest, they do not get into the deep details. And that's why I wanted to show you first what they said. Well, they're interested in the economy, how it looks like we could be entering a period of additional lockdowns and so on. That's true, of course, but the markets don't react to that. Even in the short term, look at what happened all the way up until February of 2020. The market completely ignored everything. The market is using this psychological mechanism and it ignores everything until the last second. And then, of course, it pops. So there's information. If you want, you can read the mainstream. This is also what it's talking about with weak retail sales, offering a preview of the coming attractions. Yes, this is affecting consumer confidence, and the consumer is suddenly out of nowhere unable to spend anymore. Well, of course, that's not the case. Look, first of all, I'll show you the charts, okay? Because on this show, you don't get just the data. You don't get just little snippets of information like the alternative news will give you. No, you get the actual data itself, and you could see the retail sales moving down again. But what's really going on here? We'll talk more about that in a second. I wanted to show you the commodities prices that make up all of these things, that make up, your house when you have to buy one, and the items that you buy in the store and so on. This is cotton. Look at the price of cotton accelerating over the last year, something like we've never seen before, all right? This happens to be moving from the bottom in April 2020 all the way, that was sitting at about, let's say, 40, 48, 49, and now today it's at 95. So this has multiplied. People are, they keep talking about the stock market gains. You could have put your money into cotton and you would have done better. Cotton. Did anybody ever think of that as an investment? But no, of course. Now, what does that mean for you? That means your t-shirts are going to be more expensive. Your clothing's going to be more expensive. And of course, they make oils out of it. There's all kinds of things that are made out of it. And of course, that means more money coming out of your pocket for the same amount of goods. You can see the commodity index as a whole. Yes, in the short term, this has come down. But over this period, let's be honest here, there have been these dips before. You could see it over and over and over again, and we're experiencing perhaps one now. It looks like it's kind of leveling off, but we are still in an upward trend, at least over the last couple months. So we're going to see what happens, but I just wanted to show you the entire commodity index because in general, yes, you can look at lumber. It has come down far from its peak. In fact, it's at 458 right now. It was at 1,700. It was unjustified to be at that level. But in general, commodities have moved up, and that means things are more expensive for you. Let's take a little turn here and talk about the treasury market liquidity sours as traders gird for taper clues. This is really the big thing. The Federal Reserve is ultimately taking control of the markets. They've done so since 2009 timeframe. And of course, the investors, the algorithms, they're looking for the clues. JP Morgan data shows market depth is at its lowest since March. Impact of each trade near the upper end of the past year's range. Essentially just saying right now, the ability to trade in the world's biggest debt market is deteriorating just as traders are on high alert ahead of the Fed's Jackson Hole meeting, which is what I've been talking about all throughout this period. They're looking for the taper, what's going to happen, and so on. And if you stick with me a few more minutes, I'm going to show you what the Bank of America Fund Manager Survey, we're talking about hundreds of billions of dollars being managed here, what they have to say. So hang in there for a minute. A key gauge of the Treasury liquidity market depth, the ability to trade without substantially moving prices, has fallen to the lowest in more than 5 months. You could show that right here on the chart. You could see that on the chart, of course, but I just wanted to show you that all we need to know is the Jackson Hole, which is coming up at the end of August, and then we have the FOMC in September. This is a huge time frame, and that's only a piece of the puzzle. As investors look to Jackson Hole, options markets see a lot of nothing. If you read the article, essentially just saying that they're not betting big around anything happening during this time frame. They give you the chart over here. Investors are pricing in relatively little volatility in the S&P 500 options ahead of Jackson Hole. Comparing this, even compared to the 2020 Jackson Hole, it's just a small fraction. So this is where the investors are today. But let's talk about this and slow down for just a second in the Money GPS insights. Weak sales suggest that the economy is in fact slowing today. People should be aware of this, of course, but we should take it with a grain of salt. Investors hope and pray that the Federal Reserve is going to wait for the taper. Please, Fed, don't taper. We know what comes after that. And as I will show you momentarily, there is this belief that the Federal Reserve is not going to taper, that inflation is going to remain where it is, and there is nothing to worry about. But only time will tell. You as an individual, as an investor, you shouldn't worry what the majority is doing. You should be actively adjusting your portfolio according to the conditions that you see. Okay, so let's move through the fund manager survey. I'm showing you this right here. There is a lot of these charts. They ask the fund managers for their information, what they think is going to happen. And like I said, it's hundreds of billions of dollars we're talking about here. This is not one individual as well. We can kind of get a sense of what's happening in the institutional world by seeing something like this. So it is very valuable. Peak boom as above trend growth and inflation continued to fall. Above trend growth and above trend inflation, you could see that right here, peaking out right now at this time. We don't know what's going to happen, but generally when it moves in this direction, it certainly comes down from there. Fund manager survey, economic expectations have fallen drastically since March. This is a net percentage saying the global economy will improve. That has moved down quite a lot. And you could see in the previous instances, going back to 2002, every time we get in that territory, it turns over. So it's not something new. Fund manager survey profit expectations have fallen drastically since March as well. So you could see the same thing here, the net percentage saying that global profits will improve. I mean, how could they? How could they, of course, because compared to 2020, obviously things looked fantastic, right? First-time investors say the margin will decrease since July 20th. If you can believe it or not, I don't know. Who knows about that? I'll show you the details as it comes out. But we experienced that during that financial crisis time frame, so we'll see. Fund manager survey investors expect roughly $1.7 trillion to be passed in the infrastructure package. This, of course, remains to be seen, but there's going to be a big package. We know that. It's going to be delivered, and those who are, let's say, part of the special interests are going to see the majority of the money. 84% expect the Fed to taper by the year end. So whether that comes towards the end of the year or whether we're going to see a Jackson Hole or the September FOMC, that remains to be seen. But there will be some action by the end of the year. How small it is and what exactly they do. Is it going to be the treasuries, the mortgage-backed securities, a combination of both? We will see. But of course, this is not good for investors because it's been a whole pedal to the metal risk on type mentality. 65% of investors think inflation is transitory. I think it's ridiculous to say that because, of course, if you look at what this really means, is the money pumping in, whether that's coming from the government or whether that's coming from the Federal Reserve, are we really to believe that this is going to be reduced? Are they going to do that? And are the companies, more importantly, are the companies going to reduce their prices? Investors expect Fed to hike rates in January 2023. So if we get some taper action happening, they're going to start tapering a little bit this year. Maybe we get a little bit more next year, but the interest rates will not be hiked even into the following year. Why do they say this? Because this is the official Fed talk. If you look at the dot plot and so on. Inflation remains the biggest tail risk. People shouldn't be surprised by this, but of course, this is the big situation. Beneath that, you see the taper tantrum, but I don't think that markets are going to have to worry that much because they're going to take it even slower. And there was no reason for them to do this in the first place. Why did they even begin printing money to get the mortgage-backed securities in the first place? Like there's no logical explanation for that. You could see this right here. If I just zoom in, the biggest tail risk, and it just takes you all the way back. And you could see inflation definitely being the biggest of the problems that they got going on. Fund manager survey, global commodities allocation has actually come down from its highs. So that has been reduced, but we're still talking about high levels. I think there's a lot of money in commodities. I've shown you the charts. You see where that money is going clearly. And this is something that investors are always going to be watching out for. Look at what happened with oil, for instance. And there's more to it than supply chain. There's more to it than the problems that are certainly could be happening. There's other factors here. There's speculative factors going on underneath this with the derivatives. 78% of investors now expect China to ease up drastically month over month. And then we have this last one, fund manager cash levels are up to 4.2%. Up to 4.2%, okay? Take it with a grain of salt. This doesn't move much. When they say that there's so much money on the sidelines and so on, look at this. Just look at this. This is the fund manager survey. They're telling you the average cash balance. And in these tough times, 2020, when there was so much uncertainty, it was at under or around that 6% mark. Now it's at 4.2%. I mean, it's not that big of a difference, okay, when they talk about money on the sidelines. Anyway, whatever. I'm just explaining it to you. I'm giving you all the details you need to know. If you want to be able to get the inside scoop, you've got to be an insider, and that is, of course, totally free. I will email you the video of the day 5 days a week, and you can get that at themoneygps.com or this card up here. Thank you for that. And of course, if you haven't already, hit that thumbs up button. When you do, you support the channel. So I want to thank you for that. And if you haven't seen this video already, you got to check it out. Click it, and I'll see you there.